Listen, you're watching the world right now thinking everything is basically fine. Markets are up. Your job is secure. Tech stocks are thriving. Your house is worth more than you paid for it. The news cycles through the same stories. Governments are doing government things. But here's the thing nobody wants to hear. The next catastrophe isn't coming. It's already here. You're just not looking at the right places. I'm going to tell you exactly what that black swan looks like, where it's already unfolding, and what you need to do right now, not tomorrow, not next year, but now to make sure you're not the person who gets wiped out when reality reasserts itself. And I'm going to do this with zero bullshit, zero hand-waving, and zero the kind of academic garbage that makes you feel smart but leaves you broke. By the end of this conversation, you're going to understand something that separates the people who survive chaos from the people who get consumed by it. You're going to see the specific structural vulnerabilities in the system that are already triggering, the ones that the consensus completely misses. And most importantly, you're going to have a concrete framework, not theory, not wishful thinking, but actionable framework for positioning yourself to not just survive what's coming, but actually profit from it. If this resonates with you, drop a comment below and subscribe. This is the conversation nobody's having, but everyone needs to hear. Let me tell you something about how your brain works, because this is where the trap starts. Your brain evolved to notice the tiger in the room. It's exceptionally good at detecting obvious threats, but what it's catastrophically bad at is detecting threats that don't fit the historical pattern, threats that are silent, threats that hide in plain sight because they're operating on a scale your experience has never encountered before. A black swan event, for those who haven't spent the last 20 years reading about tail risk, is not a prediction problem. It's not about forecasting. A black swan is something that has three fundamental properties. It's an outlier far outside the realm of regular expectation. It carries an extreme consequence. And after the fact, we create narratives that make it seem inevitable, like we should have seen it coming. The problem is that we don't see them coming because our institutions, our media, our education systems, everything is structured to prevent us from thinking about them. Here's the real nightmare, though, and this is where I need you to lean in, because this is not abstract philosophy. The next black swan is different from 2008. It's not a financial crisis that plays out over weeks and months. It's structural. It's already moving. And worst of all, it operates under conditions where most people's standard protective strategies won't work. Think about the architecture of our current world. We have unprecedented concentration in technology, finance, energy, and supply chains. We have debt levels at sovereign, corporate, and personal scales that dwarf anything in human history. We have systems so interconnected that a hiccup in one place creates cascading failures everywhere else. We have central banks that have painted themselves into a corner with zero interest rate policy for 15 years. We have geopolitical tension that hasn't existed in decades. We have artificial intelligence being deployed into the backbone of critical infrastructure by people who don't understand exponential risk. We have a generation of investors who have never experienced a real bear market and think drawdowns are buying opportunities. Now look at what happened, not historically, but in the last 3 years. In 2022, the Federal Reserve raised interest rates for the first time in years. What happened? Credit markets started showing stress signals nobody was paying attention to. In 2023, we had regional bank failures, SVB, Signature, First, Republic, that were supposed to be impossible in a modern banking system. In 2024, volatility returned to markets in ways that caught most professional investors completely flat-footed. And here's the thing, these weren't black swan events. These were tremors. These were the earth beginning to move before the earthquake. But most people experience them as noise. The real black swan is what happens when the illusion of control breaks, when the market discovers that the emperor has no clothes, and that discovery, when it comes, will be catastrophic precisely because it will be unexpected by the majority. That's not pessimism, that's mathematics. Let me introduce you to a thought experiment that will change how you see the world. Imagine you're a banker in 2007. You're making extraordinary amounts of money. Your models say everything is fine. Your risk management systems say you're hedged. Your peers are all doing the same thing. Your compensation committee is happy. Your shareholders are thrilled. Your compliance officers sign off. The regulators nod along. Everyone you know is saying the same thing. Housing prices never go down. Now, flash forward to 2009. Your bank has received a government bailout. You've personally lost millions. Your company laid off half its staff. Your retirement is wiped out. But here's the haunting part. Nothing you actually did changed between 2007 and 2009. You had the same risk. You had the same exposure. You had the same fragility. The only thing that changed was reality catching up to the fiction you were all collectively maintaining. This is not a historical lesson. This is the exact same dynamic happening right now, except bigger, more complex, and more fragile. You're living in 2007 again. You just don't know it yet. The difference this time is that the warning signs aren't hidden. They're everywhere. The problem is that noticing them requires going against the consensus. It requires thinking about scenarios that Wall Street economists say are very low probability. It requires admitting that the models everyone relies on are fundamentally broken. It requires saying out loud that we're running an experiment with civilization itself on a system nobody truly understands. And here's what most people do when they face that choice. They don't make it. They go with the crowd. They assume that if something were really that dangerous, someone important would have already sounded the alarm. They tell themselves that smart people are already thinking about this. They go back to whatever they were doing before. This is how you lose everything. Not through a dramatic mistake. Through the accumulated weight of 1,000 tiny decisions to trust the consensus when the consensus is fundamentally broken. Let me get specific about what I'm actually concerned about, because vague warnings don't change behavior. First, there's the interest rate situation. For 15 years, we artificially suppressed interest rates to near zero. What did that create? It created zombies. These are companies that shouldn't exist in a functioning market economy. They can't cover their interest payments with operational cash flow. They only survive because debt is cheap. But debt isn't cheap anymore. We're now at interest rates around 5%, and the math is getting real. What do you think happens to companies that were only profitable because money costs 0%? They start to die. And when they die, they default on their debt. When they default, their creditors, pension funds, insurance companies, banks absorb losses. When those institutions absorb losses, they have less capital to lend. When they have less capital to lend, everything else gets more expensive and less available. This isn't complicated economic theory. This is accounting. The zombie companies aren't hiding. They're public. You can see them. Tesla is valued at a price-to-earnings multiple that suggests they're going to grow at 40% annually, forever. WeWork once tried to go public when it was burning through cash faster than a flamethrower burns through gasoline. Cryptocurrency companies are trading on the theory that scarcity creates value, except scarcity of what? Lines of code? The entire technology sector is built on metrics that have absolutely nothing to do with actual profitability. Valuations are disconnected from fundamentals not by a small margin, but by orders of magnitude. And here's the thing. This isn't a prediction. Look at the actual numbers. The Fed chart on zombie firms, the corporate debt market, the commercial real estate sector, which has reached a state of crisis that would make a third world country look stable by comparison. These things aren't hidden. They're published. They're in the data. The only reason they're not in your model of the world is because noticing them would require you to contemplate scenarios you don't want to contemplate. Second, there's a debt situation at a sovereign level. Now, I understand that government debt is technically different from personal debt because governments control the currency they borrow in. I've had that argument 1,000 times. I get it. But here's what I also get. Math doesn't care about currency. If you're spending more money than you're earning, eventually something has to give. The United States runs a fiscal deficit that's approaching 7% of GDP. That's not normal. That's the kind of number you see in countries that are about to experience a currency crisis or a severe inflation spike or both. Now, a lot of people will tell you that the US can just print its way out of this. Sure, you can print your way out of debt, but what you print your way out of is purchasing power. Your savings get decimated, your labor is worth less, your costs go up, your ability to invest goes down. And if you own bonds, which pension funds do, which insurance companies do, your fixed income becomes a fixed loss. The bond market knows this. By the way, watch the long-term bond yields over the last year. They're moving up significantly. The market is pricing in either inflation or a fiscal catastrophe, or both. You don't need to be an economist to understand what that signal means. Third, and this one is actually more immediate than the financial stuff, there's the fragility of our supply chains and infrastructure. I'm talking about the physical world, not the financial world. During COVID, we discovered something. If there's any disruption at all in global supply chains, suddenly you can't get semiconductors, toilet paper, baby formula, or anything else. The entire system is optimized for perfect conditions. There's no buffer, no slack, no resilience. It's a just-in-time system built on the assumption that just-in-time will always work. Now picture a real disruption, not COVID, which for all its damage was relatively contained, a solar flare, a major cyber attack on port operations, a shipping channel blocked for weeks, a political crisis that disrupts a key supplier region. Any of these happens, and suddenly the stores are empty. Not maybe, not theoretically, actually. And here's the thing. People panic when stores are empty. Panic cascades into chaos. Chaos cascades into social instability. Social instability cascades into political extremism. And then we're not talking about markets anymore. We're talking about the stability of the civilization itself. This isn't doomsaying. This is fragility analysis. It's a technical assessment. Fragile systems break under stress. Ours is fragile. It will face stress. Therefore, it will break. The only question is when and how badly. Now, here's where most people lose me. They nod along to everything I just said. They get the intellectual argument. They understand the structural vulnerabilities, but then they walk away and don't change a single thing. They keep the same job. They keep the same investments. They keep the same debt structure. They keep consuming the same media narrative. Why? Because your brain doesn't change behavior based on abstract information. It changes behavior based on identity and skin in the game. Your brain says, well, if this is really true, then everyone would already be doing something about it. Nobody I know is doing anything. Therefore, it's probably not true. Your brain is running a crowd-following algorithm masquerading as rational thought. But here's the thing. Crowds are wrong about tails. Crowds are right about the middle. Crowds predict correctly that the sun will rise tomorrow and you should probably eat breakfast. But ask crowds about low probability, high consequence events, and crowds are catastrophically wrong. This is because the crowd's probability assessment is based on historical frequency. Most events that seem like they could happen don't. Therefore, most people are systematically blind to the ones that do. When I say the next Black Swan is already here, I'm not making a prediction about the future. I'm describing something already in motion. I'm saying, look at the current state of the system. Look at the concentration of risk. Look at the debt levels. Look at the geopolitical tension. Look at the inflation that's still lurking just beneath the surface. Look at the zombie companies. Look at the fragility. These aren't future states. These are present states. They're already here. The Black Swan happens when reality has to adjust to match this underlying condition. It happens when the price of something has to be repriced because the assumptions underlying that price have become indefensible. It happens when confidence breaks, and confidence breaks fastest in crowds, because once the first person acknowledges the emperor has no clothes, everyone can suddenly see it. The timeline is uncertain. That's not the same as saying it won't happen. The wind doesn't blow on a schedule either. But if you don't secure your windows, the wind will blow your house apart. Okay? So you've got the diagnosis. Now for the harder part, what do you actually do about this? Because this is where theory meets the brutal reality of your life, your job, your family, your obligations. First principle, stop trying to predict when it happens. This is perhaps the most important thing I can tell you. You will never know when a black swan arrives. If you could predict it, it wouldn't be a black swan. It would just be a regular event that everyone was prepared for. So let go of the fantasy that you're going to time the market. You're not, nobody is. The people who successfully protect themselves against tail risk don't do it by timing. They do it by positioning. They build portfolios, life structures, and businesses that benefit from chaos instead of being destroyed by it. This is the barbell strategy, and it's not complicated. So don't let anyone dress it up as something more sophisticated than it is. You take the vast majority of your capital, I'm talking 85, 95%, and put it somewhere safe. Not profitable, not exciting, not going to make you rich. Safe. Treasury bonds, cash equivalents, boring index funds, tracking dividend-paying companies with decades of history, boring real estate, boring savings, things that generate positive cash flow and won't collapse if the world gets interesting. Then you take the remaining 5-15%, and this is the crucial part, and you put it into things that become extraordinarily valuable if everything breaks. This means tail hedges. This means options on a market downturn. This means positions that go up when volatility goes up. This means some cryptocurrency if you can afford to lose it. This means a small business you can run yourself that provides value when normal systems fail. This means skills that are valuable when everything is disrupted. The key insight is this. The barbell is not about diversification in the traditional sense. It's not let's spread risk evenly across many things. It's let's eliminate the middle where we're exposed to everything but defended against nothing. The middle is where fragility lives. The barbell is where antifragility lives. Now, most people hate the barbell strategy when they hear it because it's boring and it feels suboptimal. You're not buying stocks and betting on growth. You're not trying to beat the market. You're protecting yourself from catastrophe while capturing upside optionality. If markets go up, you make money, but not as much as you would have if you'd gone all in. If markets crash, you don't get destroyed. You actually profit from the crash. And over a lifetime, people who use the barbell strategy end up ahead of people who bet everything on growth, because the crashes happen with enough regularity to swing the calculation. Here's the second principle. Reduce complexity in your life and consolidate your risks. This is where most of your actual fragility lives, not in your portfolio. It's in your life structure. You know what's fragile? Debt, especially consumer debt, credit card debt, auto loans, adjustable rate mortgages on property you can barely afford. These aren't just financial instruments. They're slavery contracts with your future self. Every month you're obligated to make a payment to someone else, which means you're not free. If you lose your job, the payments don't stop. If something goes wrong, you don't have flexibility. You're locked into a trajectory that requires everything to go exactly according to plan. Now look at what happens when a black swan hits. People lose jobs, businesses collapse, hours get cut, projects get canceled, the income you were counting on evaporates. If you're highly leveraged, you're done. You're at the mercy of forces you can't control. But if you've designed your life so that you can live on 70% of your normal income and have 30% margin for error, a disruption is just a minor inconvenience instead of a catastrophe. This isn't a philosophy. This is optionality. It's the ability to make choices. It's the difference between being forced to do something because you need the money and being able to choose what to do because you have time and resources. That's freedom. That's also antifragility. The third principle, develop actual skills that survive disruption. Not theoretical knowledge, not credentials, skills, things you can actually do. Things that are valuable outside the normal system, when the normal system breaks. You see this in history constantly. The people who survived economic collapses weren't the ones with the highest credentials. They were the ones who could fix things, make things, grow things, understand supply and demand at a grassroots level, communicate, negotiate. The people with PhDs in theoretical physics were the ones most screwed because their entire value proposition was based on a functioning academic system that no longer existed. Now, I'm not saying quit your job and become a farmer. I'm saying what would happen to your life if your industry disappeared tomorrow? What would you do? How would you make money? If the answer is, I have no idea, then you have a fragility problem. You're dependent on a specific outcome. You're betting everything that your industry, your job, your company will continue to exist in its current form. That's not a strategy. That's prayer. Build skills that are portable, real, and valuable in conditions of stress. If you work in finance, learn to fix engines. If you work in tech, learn to cook and manage people. If you work in management, learn to make things and think clearly. Doesn't matter if you never use these skills professionally. What matters is that you develop them so that if the primary system breaks, you have options. Options are what save you. Let me give you something more concrete. Let me describe what protecting yourself actually looks like in practice. Step 1, stop consuming financial media. Completely. I'm not exaggerating. Financial media's entire business model is to keep you in a state of mild anxiety, so you keep paying attention. So it shows you the volatility and ignores the signal. It creates the illusion that everything is a prediction puzzle that you need to solve moment by moment. It's poison. It rewires your brain to focus on noise instead of signal. The market is up 2%. Who cares? The market is down 3%. Who cares? These movements mean nothing. What matters is your portfolio structure over years and decades. But you can't build that while consuming a constant stream of noise. Step 2, audit your actual cash costs. Not revenue, not income, not theoretical earnings. Actual cash required to pay your essential obligations every month. Housing, food, insurance, utilities, transportation. The irreducible minimum required to keep you and your family alive and functional. Calculate this precisely. Write it down. Now look at your income and ask yourself, what happens if I lose 50% of my income tomorrow? Can I still cover these costs? If the answer is no, you're fragile. You need to reduce costs or increase stability until the answer is yes. Step 3, eliminate consumer debt entirely, not eventually. Now, this is non-negotiable. Consumer debt is the opposite of anti-fragility. Every dollar of consumer debt is a chain tying you to a future obligation when you need flexibility the most. I don't care if it's at a low interest rate. I don't care if you can afford it. Debt is fragility. Your job is to become fragile-proof. Step 4, build cash reserves. Not the amount your financial advisor told you to build based on spreadsheet models. Real money. The amount you could live on for 2 years without any income at all. Some of this should be in actual cash in a safe place. Some should be in highly liquid assets like money market funds. Some should be in bonds. This isn't an investment. This is insurance. This is your freedom. This is your ability to say no to things that are bad for you. This is your ability to wait for good opportunities instead of being forced to take bad ones. Step 5, buy the barbell. Put the vast majority in boring, safe assets. Put a small percentage in tail hedges. Buy out-of-the-money put options on broad market indices. Buy physical gold and keep it somewhere safe. Buy some non-correlated assets. Buy some assets in other countries and other currencies. Own some real estate you could live in if you had to. The specific allocation matters less than the principle. You're building a portfolio that actually survives stress instead of one that just works when conditions are normal. Step 6, develop the psychology of antifragility. This is the hardest part because it goes against your instincts. Antifragility means you actually want stress. You want volatility. You want disruption. Why? Because disruption is where opportunity lives. When everything is normal, competition is fierce. Everyone's doing the same thing. Everyone's trying to optimize the same metrics. But when a disruption happens, when the system breaks, the people who are positioned to benefit get outsized gains. Your goal is to be positioned so that chaos makes you money. Your goal is to have enough skin in the game in the right places so that when things break, you're actually happy about it. This requires a fundamental shift in your psychology. Most people are addicted to stability. They want the world to never change so they can execute their plan unchanged. But the world always changes. Disruption is constant. The only question is whether you'll be destroyed by it or empowered by it. And that depends on your positioning. Now, I want to address something that's going to be going through your head right now as you process this. Because I've seen this reaction 1,000 times. You're thinking, this sounds paranoid. This sounds like doomsaying. This sounds like I should be constantly anxious and always preparing for catastrophe. That's no way to live. You're right. That is no way to live. And that's not what I'm describing. What I'm describing is rationality. What I'm describing is building a life structure that doesn't require anything unusual to go well. Most people build their lives on the assumption that everything will be fine, that they'll keep their job, that the economy will keep growing, that their home will keep appreciating, that the system will keep functioning, that nothing unusual will happen. Then when something unusual does happen, they're blindsided, they suffer, they lose everything they built. A rational person builds their life so that things being fine is just a bonus. They position themselves so that the baseline is security and safety, and anything beyond that is profit. They're not anxious, they're peaceful. They don't need the world to cooperate with their plan. They've positioned themselves so that the world, cooperating or not cooperating, doesn't really matter. That's not doomsaying. That's wisdom. It's the opposite of anxiety. It's freedom. Think about it this way. If you've eliminated your debt, if you've built your cash reserves, if you've diversified across multiple income streams, if you've developed skills outside your primary field, if you've bought your hedges, then a market crash isn't a threat. It's an opportunity. A recession isn't a danger. It's where the money gets made because you have time and capital while everyone else is panicking. A job loss isn't a catastrophe. It's a chance to do something else you've always wanted to do. That's the real value of this positioning. It's not security in the pessimistic sense. It's freedom in the actual sense. It's the ability to weather whatever comes and still be standing. It's the ability to say no. It's the ability to take risks that actually matter because you're not dependent on every month going exactly as planned. Let me tell you what happens to the people who don't do this. And I need you to imagine this clearly because this will change your behavior more than any abstract argument I can make. 2008 happened. A lot of people lost their homes. But that's not the worst part. The worst part is what happened in 2010, 2011, 2012, years later. Those people were still trapped. They were trapped in houses that were worth less than they owed. Trapped in jobs they hated because they couldn't afford to leave. Trapped in marriages they should have ended because they couldn't afford the separation. Trapped in debt. Trapped in a state of permanent anxiety because everything was fragile and they knew it. Meanwhile, other people were fine. Not because they predicted the crisis, not because they were smarter or more educated, but because they'd built their lives on a foundation that could absorb the hit. When 2008 came, they didn't lose everything. They lost some money, sure, but they still had a foundation. They still had time. They still had choices. And then when 2009 came and assets were cheap, they could actually buy while everyone else was forced to sell. That difference is everything. That difference is literally the difference between a life of freedom and a life of captivity. Now look at 2024. We're in a world where tech stocks are at all-time highs, while commercial real estate is in crisis. We're in a world where government debt is unsustainable. We're in a world where the political situation is destabilized. We're in a world where supply chains are fragile. We're in a world where interest rates are higher than they've been in 20 years, and people are still carrying record debt loads. We're in a world where one bad month could start a cascade. The people who are going to be fine when this breaks are the ones who position themselves now, not the ones who wait until it happens and then try to figure out what to do. Now is when you need to act. Now is when debt is cheap to pay off. Now is when assets are available. Now is when you can build your reserves. Now is when you can actually think and plan without being in crisis mode. In a year or 2 years, if something breaks, you're going to wish you'd done this. You'll regret every month you didn't spend building your foundation. Every month you borrowed for something you didn't need. Every month you didn't develop skills or diversify your income or get your life structured. Don't be that person. Here's what I want you to understand about Black Swan events that nobody talks about. They're not random. They're not purely probabilistic events that emerge from nowhere. They're the inevitable consequence of building a system with hidden fragility and ignoring the warnings until the system can't ignore them anymore. Think about how information moves in the world today. 100 years ago, if there was a crisis in one part of the world, it took weeks or months to get to another part. Now it takes seconds. A company fails. Instantly, its counterparties know. Instantly, their investors know. Instantly, credit markets freeze. The problem is our institutions are still designed for a world where information moves slowly. So we have speed moving at light speed, and institutions that process information like it's still 1,950. That creates fragility. That creates cascades. That creates black swans. The same with debt. Our institutions are designed to function when debt levels are reasonable. When corporate debt to earnings ratios are 2 or 3 times, now we're at 5, 6, 7 times. The underlying mathematics has changed, but the institutions haven't. So the system is increasingly fragile. When interest rates go up, suddenly companies can't service their debt. When they can't service their debt, they default. When they default, their creditors lose money. When creditors lose money, they stop lending. When lending stops, everything that depended on rolling over debt fails. This isn't theoretical. This is inevitable mathematics. It's not a question of if, it's a question of when. The same with equity valuations. Companies are valued based on assumptions about the future, but those assumptions are only as good as the models that generate them. And those models are notoriously bad at pricing in tail risk. So we build up valuations based on the assumption that everything will be normal, and then when something unusual happens, the valuations collapse because they were never based on reality. They were based on the assumption of normality. This is not normal times. The deviation from normal is getting larger. The system is getting more fragile. The tail risk is getting larger. The only question is, which tail event breaks first and how badly it breaks? And here's the thing that nobody wants to admit. We probably can't stop it. The structural vulnerabilities exist. The debt exists. The fragility exists. We can't just decide that everything will be fine and have it be fine. The debt has to be dealt with. The system has to rebalance. The fragile parts have to break and be rebuilt. We're not going to avoid this. We're going to walk through it. The only question is whether you walk through it intact or destroyed. Let me give you the concrete things you should do this week. Not eventually, this week. 1, calculate your monthly cash burn. Sit down with a spreadsheet. Write down every mandatory payment you make. Mortgage or rent, insurance, utilities, food, transportation, childcare, healthcare, debt service, everything. Get a number. Know it precisely. 2, calculate your liquid assets. How much money do you actually have access to right now? Not how much could you have in theory. How much do you actually have? Be honest. 3, divide your liquid assets by your monthly cash burn. That's your runway in months if all income stopped. If that number is less than 12, you're in crisis waiting to happen. Your first job is to extend that number to at least 24 months. 4, look at your consumer debt, credit cards, auto loans, personal loans, anything other than a mortgage. Set a timeline to eliminate it, not eventually, with a specific target date. Use every possible dollar to accelerate this. 5, find one recurring expense you can cut completely and one way you can increase your income. Cut the expense first. Use the freed up cash to build your reserves or pay down debt. Find a way to make extra money, side gigs, freelancing, selling things, and put all of it into your financial foundation. Don't spend it. 6, buy one book on financial self-defense. Learn how your money actually works. Learn about inflation, debt, currency, options. Learn the vocabulary so you can understand what's actually happening in the world instead of just consuming the narrative that smart people are telling you. 7, find one person, a friend, a family member, a trusted advisor, and have a real conversation about money and fragility. Tell them what you're learning, ask them what they're worried about. Stop pretending that money is something you don't talk about. Start actually talking about it. That's 1 week's work. If you do that, you've moved from the passive state of hoping everything works out to the active state of actually building a foundation. You've shifted from victim to agent. You've started. Now here's the thing about knowing what I just told you. You can't unknow it. You can't go back to the comfortable narrative that everything is fine and someone else is handling it. You know now that the system has structural vulnerabilities. You know that debt is unsustainable. You know that fragility is increasing. You know that a black swan is likely. You know that the people who've positioned themselves will be okay and the people who haven't won't be. The question is what you're going to do with that knowledge. You're going to do one of two things. You're going to act or you're going to rationalize. You're going to spend 2 hours this week building your financial foundation. Or you're going to spend 2 hours convincing yourself that you don't need to. You're going to start paying down debt or you're going to keep spending. You're going to build your reserves or you're going to assume the government will bail you out like it bailed out the banks. Most people will rationalize. Most people will do nothing. That's just statistics, and that's fine. The world needs people to maintain normal conditions. Most people play the game of pretending that normal will continue forever. And most of the time, it does continue. Most of the time, their bet works out until it doesn't. But you're not most people. You're the person who spent the time to actually think about this. You're the person who understands that black swans aren't rare events in a chaotic universe. They're inevitable events in a fragile system. You're the person who's going to act. The question is just whether you'll act now, when it's easy, when you have time, when conditions are normal, or whether you'll wait until the stress starts showing, until the first tremors, until the system starts breaking. Because I can promise you, waiting is the wrong choice. By the time you see the crisis, it's too late to position yourself. By the time you admit that your life structure is fragile, your options are gone. By the time you realize your job isn't secure, you don't have time to develop alternatives. Right now, you have time. Right now, you have optionality. Right now, you can build, use it. This is the conversation that needs to happen. This is what financial prudence actually means in a world with tail risk. Not sexy, not exciting, not the kind of thing that makes for great cocktail conversation, but real. And when the disruption comes, real is what matters. The next black swan is already here. You just can't see it yet. But you can see the fragility, you can see the debt, you can see the concentration, you can see the structural vulnerability, you can see all of it if you actually look. So look, and then act, because your future depends on it.